So we've looked into combining volume with candlestick patterns, and we've also looked at the RSI indicator. In this lecture, I want to look at how we might be able to combine the candlestick patterns with the moving average indicator. Moving averages are very popular among traders because they're able to show the overall trend in the security, and they offer a more objective approach than, say, trend lines. For instance, it's much easier to backtest a moving average than it is a trend line, which can be subjective to the individual trader. Another way we might use a moving average is as a level of support or resistance within a trend or a range. For example, traders will often look at the 20-day, 50-day or 200-day moving averages as a key line of support, and they might expect price to bounce off of some of these important levels. So in this test, I'm going to overlay a 20-day exponential moving average, EMA, over the chart, and then we're going to combine it with the hammer candlestick pattern that we discussed earlier. I think a hammer will be a good choice here because it shows a security that has rejected lower price levels, then finished the day back where it started. So the idea here is that we are going to buy the hammer pattern on the close, but only if the candle at some point trades through the 20-day EMA, which will then hopefully act as an area of support. To set this up, I'm going to instruct AmiBroker to buy when there's a hammer pattern, and when the low is below the 20-day EMA, and the open of that candle is above the 20-day EMA. So the kind of setup we're looking for is one like this in Gilead Sciences. The market has opened above the 20-day EMA. It's then traded under the moving average line, which has acted as a support, and then the stock has come back and finished in a hammer pattern. So in order to code this correctly, the moving average price here will need to be calculated using the open instead of the close in order to avoid any look-ahead bias. If you recall, the hammer pattern wasn't a particularly profitable signal on its own, and our best result in futures came from a 10-day holding period where we recorded an average loss of 0.01%. Meanwhile, our best result in S&P 100 stocks was an average profit of 0.19% per trade over 10 days. So now we can run the pattern again, but this time including our additional EMA rule. As you can see now, if you look closely at the results, adding the extra EMA rule has improved the average profit per trade on every test except for one. For example, with a 1-day holding period in futures, we've gone from an average loss of 0.1% to an average gain of 0.21%. And arguably our best result came with a 5-day holding period where we recorded an average profit per trade of 0.54% with a 65% win rate. And this has improved from a 0.02% average loss. In stocks, we also saw improved performance. For example, over 5 days, we've gone from an average profit of 0.09% per trade to an average profit of 0.36% per trade, although we did see a poor result using a 10-day holding period. But overall, I think the results have been pretty positive, and the extra rule has helped us to find some more profitable hammers. Remember, the results here are from buying a hammer on the close, but only when the candle has at some point tested the 20-day EMA line. The downside here, again, is that we did see a lot fewer signals.